Good afternoon, everybody, and thank you for joining us. Unfortunately, my colleague Dane is absent today. He's not well, so you have me, Dave Jennings, to talk through this afternoon's topic, which is HMRC and cryptocurrencies. What happens if the Revenue open an inquiry, or if you need to make a disclosure? So, without further ado, I will start the slides. Here we go. So Churchill Tax advisors provide full services. We work a lot with accountants and solicitors and direct with clients as well. So we can provide expert help to other firms who need advice on specialist subjects, as well as taking direct instruction from clients. If you have any questions today, you can pop them into the Q&A box on the side there. If you're watching the video, obviously, please contact us if you do have any questions. So, as I mentioned, today we're going to talk about the HMRC and cryptocurrencies, Bitcoin and similar forms of token type funds. We're going to briefly cover the tax basics. This is not a technical discussion around cryptocurrencies, but there is just a headline really around the basics. We are aware HMRC are issuing what's known as nudge letters, and we will cover disclosures and inquiries. So what are the basics of cryptocurrencies? The Revenue do not accept, and the government do not accept, that Bitcoin and the like cryptocurrencies are a currency per se. They're not money, they are an asset. And therefore they potentially can be taxed slightly differently. The Revenue do not accept that trading in cryptocurrencies is gambling. It's not gambling. How they are taxed depends on how those currencies, the cryptocurrencies, the tokens, the funds are actually used, and we'll cover that in the next couple of slides. So it's how those funds are used, more importantly, than what those funds actually are. If, on the other hand, they are linked to financial funds, such as derivatives, where you've maybe got contracts and options and things like that, then they will be taxed under the financial rules relating to those derivatives or contracts, rather than the cryptocurrencies themselves. But today we're mainly just talking about the use of cryptocurrencies for investments or trade and things like that. Obviously, they can be held in the UK, or they may be overseas. That can be quite a complex issue over where's the site of the exchange, where's the site of the funds, where are they held? Are they in the UK or are they offshore? However, generally, as we've said, we're looking at the underlying use of those funds as opposed to the location of where those funds are actually held. We would advise to keep detailed records of any transactions, because the issues can get quite complex over timing and matching those funds going in and out, losses, gains, etc. So, how are they taxed? As we've just mentioned, it's the nature of the use, what those funds are used for. If you are investing in cryptocurrencies, then you may have a gain or a loss. Bitcoin, for instance, and many cryptocurrencies ballooned in 2021 and reached a big peak last year. In the beginning of this year, they've dropped again. So if you buy or sell at particular points in the market, you will have a value at that time, and that could then result in a gain or a loss when you subsequently dispose of those particular cryptocurrencies. So that's going to be treated as in an investment, and there'll be capital gains tax to pay. If, on the other hand, you are in business and you sell or buy goods and you receive or pay in cryptocurrencies, then that value of those tokens, those coins, will be taxable as trading income. So in effect, it's like receiving a check or cash to the amount of the cryptocurrencies. So you'll still be liable within that trade. So if you are buying and selling goods, then those goods will be sold maybe to profit. That profit will be your trading income, and that might be through self-employed or partnership or limited company. And don't forget, VAT would still be due on those trades. So if the cryptocurrencies are used to trade goods as a trader in business, then it's just treated as business income or business expenses in the same way as cash would be. If you're being paid in cryptocurrencies as an employee or paying employees as an employer in cryptocurrencies, again, the value of those funds will be treated for PAYE income tax and national insurance in the same way as if you're paying in cash. If you're buying and selling property or land and using cryptocurrencies, then stamp duty SDLT will be due in the same way as well. Equally, if somebody dies and they hold cryptocurrencies as an asset, they may be liable to inheritance tax depending on thresholds. So all the general taxes are still due. It depends on how those funds have been used in the business or as an investment or as an employee or land inheritance, etc. Trading in cryptocurrencies, if you might be treated as an actual trader. So if your nature of trade, and this is an area that is, again, quite a complex area, you have to consider what's known as the badges of trade. If you're trading in crypto in the nature of trade, if you're with the intention of running a business, in effect, in trading, then that buying and selling of those tokens, those funds, those coins, if you're a trader, it's a bit like being a stock market trader or a professional gambler. As we've said, the revenue don't consider investing in cryptos as gambling, but you could be a professional trader. That might be your trade. Buying and selling crypto could be a trade itself. And then again, you'd be taxed on profit or loss on that buying and selling. If you're using those cryptocurrencies to swap with other assets, then again, they may be part of trading. If you're actually one of the cryptocurrency miners, then mining coins, it would also be a trade. And obviously, if you're swapping or providing any goods or services in exchange for Bitcoin or cryptocurrency, then that also may be in the nature of trade and taxable as trading income, resulting in obviously making tax returns to HMRC on an annual basis in the same way as any other trader or person with self-assessment liabilities. So what we have seen is, the revenue have got wind of this. They're catching up and realizing that cryptocurrencies have become more popular. People are using them for trading. People are using them for investing, and HMRC do have access to information. It's been reported that they've agreed with Coinbase, one of the exchanges for cryptocurrencies, to provide information to HMRC for any holding or transaction in excess of £5,000. So HMRC has that data. We mentioned there the revenue has a huge Connect database which holds this information and other information on all taxpayers in the UK. We've covered on some previous seminars the revenue have information about land transactions from the land registry. They will have information on stamps from stamp payments. They will have information from council tax, maybe from letting agents. They will also have shared information from offshore countries, financial information that overseas authorities share with the UK and vice versa. So they use that information to check against what are they holding for individuals' tax returns or company tax returns, partner tax returns, etc. And if when they check that information on their database, something isn't quite right, they may open a formal inquiry into a tax return, or into an individual or a business, or a company, or they may issue what's known as a nudge letter. That's a bit of a it's almost like a phishing exercise, really. The revenue have some information, and they think that there's maybe tax at risk. So they're giving people an opportunity to come forward, disclose their income or gains before the revenue open inquiry. If you ignore such a letter, the revenue will treat that as a deliberate action, and that can result in far higher penalties than if you comply and check the notice. It doesn't mean that tax is due. It's just the revenue's notice saying, check your tax affairs, take advice. If tax is due, you need to disclose it. And if it's not due, then you still need to tell the revenue you've made losses, which you might be able to claim and then carry forward, or you can confirm to the revenue there's no tax liability. If you fail to comply, the revenue do have powers to obtain that information, and if you still fail, they can issue penalties. They can issue information notices to data providers, data handlers, and exchanges, as we've seen with Coinbase being reported. And no doubt they've issued notices to similar cryptocurrency exchanges for information. So how can you disclose if you've not told the revenue about income in recent years that involve cryptocurrencies or other trading income? If you've had one of these nudge letters or an inquiry, that's going to be treated as a prompted disclosure. If it's a wholly voluntary disclosure, before you get one of these letters, it's going to be unprompted voluntary disclosure, and that will result in lower penalties. If you've got offshore issues, you can use the worldwide disclosure facility, and we covered that in our previous seminar in December. If it's just purely UK, then you can use the digital disclosure service, which, as it suggests, is an online disclosure service. What these worldwide disclosure and digital disclosure service facilities offer is the ability to self-assess the liability, the interest, and the penalties. You do have to work that out yourself and submit to HMRC, and they will then review the disclosure. You have 90 days from the initial registration of an intention to make a disclosure to actually get the information together and tell HMRC all the years and all the liabilities. You could then potentially agree and negotiate an instalment plan if you can't pay in full. The last one there we've covered in previous seminars as well, no doubt we will come across again in the future, is the contractual disclosure code of practice 9. That's the more serious cases where the revenue may seek to prosecute for tax evasion. There is a risk with cryptocurrencies. In the relevant case, the revenue may seek to make an example, or they may have other information, or there may be a reason why the revenue wants to prosecute. It can be a criminal offence for failing to disclose tax liabilities to HMRC. It can be treated as tax evasion, and the revenue can prosecute that. Code of Practice 9, the contractual disclosure facility, if offered by the revenue, or if sought voluntarily from the revenue, can give an immunity from prosecution, providing full disclosure and cooperation is made with HMRC. So how far back can the revenue go when they issue a nudge letter, or if you need to make a voluntary disclosure? Generally, the rules as outlined here, if you can prove you've taken reasonable care to get your tax affairs in order, but for one reason or other haven't, then you need to make a 4-year disclosure, or the revenue will go back 4 years. That's generally for things like mistake, or if, I say, you can prove you've taken reasonable care. That might be getting professional advice from a qualified tax advisor saying there was no tax liability, but that advice was incorrect or wrong. You may have grounds to say, well, you've taken reasonable care, it's not your fault. But again, you've got to have evidence of that. Ignorance or naivety would be treated as carelessness. So if it's UK, the revenue can go back 6 years if you've completed incorrect tax returns, or again 20 years if it's been deliberate and fraud, having completed incorrect tax returns. There is an anomaly in the rules that if you've never completed a tax return, the revenue can go back 20 years, even if it's through ignorance or naivety, what's known as carelessness. The revenue can collect liabilities, or disclosure needs to go back 20 years for careless mistakes with not reporting to the revenue on time. There's a requirement to tell the revenue each year of taxable income or gains, and failure to do so is what's known as failure to notify. If it's offshore, those time limits are extended. If your behaviour was careless, the revenue have up to an extra 12 years on top of the. It's extended to 12 years, rather. A maximum of 12 years if it's offshore and it's been careless or even reasonable care. But that's new legislation, and the backstop is 13, 14 for careless, 15, 16 for reasonable care. But as time goes on, obviously the revenue will have up to the full 12 years to go back, even if it's careless and not fraud or deliberate. They still have, again, 20 years if it's deliberate or fraud, whether it's UK or offshore. So the penalties vary, whether it's prompted or unprompted. So the advantage of making a voluntary disclosure is your penalties are going to be massively reduced. If it involves offshore income pre-2015-16, then you're looking at the worst case scenario of 200% penalty. If it's prompted, the minimum is 150%. If it's unprompted voluntary, the minimum is 100%. So you've got a 50% saving there if it's offshore, coming forward and making a voluntary disclosure for those earlier years. For later years, the rules have changed slightly. We've not got them all on here. We have covered in previous seminars. The table would be quite complex to go through in the time that we have today. But we can obviously stress that coming forward and cooperating reduces the penalties HMRC can charge. If it's UK, it ranges up to 100% maximum of the tax that's owed. It's a penalty on the tax, not the income, although sometimes there can be extra penalties charged as well. You can mitigate them down, and equally, sometimes you can end up with a zero penalty depending on the circumstances and making a voluntary disclosure. The quantum of the penalty does depend on behaviours we've covered, whether it's careless or deliberate, or you've taken reasonable care. It also depends on what's known as the quality of the disclosure. So that's telling the revenue on time, providing information, disclosing what's wrong, and helping the revenue to get to the correct figures. All of that helps reduce the penalty down from the maximum to the minimum. So you may be able to reduce your penalty from, say, 35% down to 15%, depending on the particular years and what's happened. So there are opportunities to mitigate penalties based on behaviours and the quality of those disclosures. So that's been a quick review of the situation with cryptocurrencies. They're not something special for how they're taxed. How they're taxed depends on what they've been used for. So if you're receiving cryptocurrencies instead of cash or check or bank transfers or credit card payments, then it's income. It's just treated as income as any other trader would receive income. If you're investing and you've made a gain on cryptocurrencies or a loss, then that's going to be taxed on the gain or the loss. If you're buying and selling land using cryptocurrencies, it's just going to be taxed in the same way as any other form of cash or money. If you're an employee, then again, you're going to be taxed in the same way as any other employee. Cryptocurrencies are not a way to hide or avoid taxes. They're not necessarily treated in any special way. Obviously, if you're trading as a miner in cryptocurrencies, that itself will be deemed a trade as well. So thank you for joining us today, and thank you for listening or watching. If you catch up on a video, please contact us at Churchill Tax Advisors if you need any help or guidance with regard to an inquiry or a disclosure for cryptocurrencies or any other income or taxes matters that you need assistance for with HMRC. making disclosures or making inquiries. Thank you very much for watching us today. Please join us in a month's time when we will have another investigation seminar. Join us in a couple of weeks' time, where my colleagues will talk about a tax planning advice and idea as well. So we run these every couple of weeks. Concurrently, myself and Dane do the investigations and disclosures seminars, and my colleague Jamal will do the tax planning, tax ideas seminars. So thank you very much for joining us. It's been great to have everybody here. Not had any major questions today, so nothing to answer directly during this seminar. But if you've got any questions, please do contact us. Enjoy the rest of your day, and thank you for joining. Bye-bye.